everyone. Great to see everyone in person. Obviously, there's a lot online too, so my beard is still here. COVID is still here too, unfortunately. But I'm looking forward. We got a good panel here. Again, we've got two apartment owners and we've got 4 apartment brokers and I guess 5 with me. So we're going to get into a good discussion. Obviously we're going to touch on rent control, as well. But just it's ironic that, the demographic guys talk about just the Twin Cities, we're one of the laggers on dynamic rent growth. Okay. And yet we're the ones that are moving forward with rent control. Just doesn't make sense to me. So anyway, but let me I'll introduce the panel. We'll get going here. Just first to my left here, we've got Grant Campbell, Senior Vice President, Investments at Ceterspace. Next to him, we've got Mox Gunderson, Senior Director for JLL Capital Markets. To his left, Matt Fransen, Chief Investment Officer, Principal at Timberland Partners. Next, we've got Abe Roberts, First Vice President, Marcus and Millichap. Then we have Steve Michael, President of Michael Commercial. And then last but not least, we have Jeff Budish, Senior Executive Vice President, Colliers International. We'll just kick it off. I wanted to reach out to, Matt Fransen first. Again, Matt, with Timberland, and hopefully I got kind of the stats right. I think you guys own like 17 states now, pushing like 20,000 apartment units. Give us kind of your perspective, just again, just maybe the overall, country, just in some of these markets, and then just obviously this audience is, interested in the Twin Cities here, but then kind of give your perspective of the Twin Cities, and we'll get going.
Sure. Thanks, Keith. Excuse me. The apartment market from our perspective nationally has never been better. Our asking rents nationally, we've got a portfolio of over 19,000 units in 17 states. Our asking rents year over year have gone up on average over 20%. I think it's 22%, which is just phenomenal. On a same store basis, EGI, which kind of lags asking rents, our EGIs for 2021 were up almost 6%. We track 18 specific markets on a same store basis. We've got a pretty heavy concentration on the Sun Belt. Of those 18 markets, our top performing market was somewhat surprisingly Memphis, Tennessee, over 11% same store sale EGI growth. In last place was the Twin Cities with 2 basis points from our portfolio of EGI growth last year. The apartment market's never been stronger. The wind is at our back at almost every market we're in, except for the Twin Cities. It's still kind of a dogfight for revenue growth from our perspective, and we're largely suburban. It's just very flat here. So the second half of last year is much better than the first, but from a grand perspective, the Twin Cities is lagging the market, and we're honestly somewhat bearish.
At the same time, though, we kind of chatted about just maybe the Twin Cities being a lagger. What do you think? I mean, what's your thoughts on that? I mean, do you think some of the political stuff we've gone through, do you think there's a pent-up demand? Do you think, maybe just elaborate just kind of a little bit of the urban, suburban, we'll get into with the brokers and that, but just how you're looking at that.
Yeah, I don't think any market in this country suffered the way the Twin Cities did. Pandemic, obviously George Floyd. I just think it put us in kind of a losing streak. But I think that there are bright spots. The exurban, I'm looking at our metrics. We bought a property in Rogers, Minnesota, we're excited about. We built one in Woodbury that's leasing up great. I think there are bright spots on the fringe. And like I said, the second half of the year was better than the first last year. So I'm kind of reluctantly positive going into 2022 that I think 2022 is going to be much better than 2021. But as we compare the Twin Cities to, Nashville, Florida, Savannah, Georgia, it's just a laggard.
All right. Well, I know our apartment brokers will be a little bit more positive. Before I get into them, Grant, again, Ceterspace, I know your stock's up over 20%, I think in the last 6 months in that. Just, again, you're not in as many markets as Timberland, but again, you're in multiple markets. Kind of give your, similar, sense on just how you're looking at our market and others.
Sure. Yeah. Thanks, Keith. Morning, everyone. Ceterspace, we're an owner operator of about 15,000 homes or units, including 5,000 here in the Twin Cities. It's interesting, over the past 6 months, 6 to 9 months for us, we've actually doubled our holdings in the Twin Cities. So while we think about all of the dynamics that we're talking about here and the relative comparison of the Twin Cities to other markets, we've certainly been making bets and making investments in the Twin Cities. We believe that, long term, if we're focused in the right submarkets and with the right assets, we're going to have success here. So we've doubled our holdings. That for us, where have we been focused in this market? We've been focused in what I'll call the opportunistic bucket. So maybe to the dismay of some of the brokers on the panel, what we're not doing in the Twin Cities right now is going through 3 or 4 rounds of bidding to try and win a fully marketed deal. We are targeting development funding participation, where we can structure something that works well for us and have a purchase option to acquire those stabilized communities on the back end. And usually that structure comes with some sort of quote unquote discount to market that creates good alignment in our minds for Ceterspace and the developer. We've also been focused on operating partnership unit transactions where, again, common theme, we believe we can create a win-win scenario for really what is a contributor and not a seller of a community or a portfolio of communities, where they execute a 721 exchange, take operating partnership units in our platform. Those units come with a whole host of benefits: tax deferral, liquidity planning, tax planning, quarterly distributions, et cetera. So if you put a bow on all of that, I would say we're trying to be scrappy and opportunistic in how we make bets in this market. As many of us are focused on the right submarkets and the right assets. So that's how we're thinking about this market relative to others. We are seeing more rent growth in other markets, certainly compared to the Twin Cities. From a new investment perspective, Denver and Nashville, which is where I spend my time in addition to the Twin Cities, capital flows are more robust into those markets. Pricing is more aggressive, assets cost more, cap rates are lower. I think we'll get into that here in a bit. When you look at our portfolio, I pulled some statistics last night. We've certainly felt pain in our urban Minneapolis and Denver communities. Suburban communities have performed well. Really in the COVID environment in 2021, we had outstanding performance in what I'll call our secondary Midwest markets. So if you look at September year to date, 21 over 20, our best performing markets were Billings, Montana, and Rapid City, South Dakota. Kind of Mountain West extended, if you put a marketing term on it. We saw 15% NOI growth there year over year. We have seen in Minneapolis, in particular in the third quarter, some nice pickup in our portfolio, heavily driven by suburban communities. Third quarter, year over year, 21 to 20, we've realized 12% NOI growth in our Twin Cities portfolio. Heavily, solely may be a strong word, but heavily driven by suburban performance. The urban assets are still lagging.
Grant, just general commentary on the public apartment REIT space. Again, you're pretty much the only, show in the, there's not a lot of public REIT ownership in the Twin Cities, but you guys are pretty much it. But just general commentary on that space, and then maybe, or how are you doing things differently than the other players, or a lot of similarities?
Yeah, so we're one of 12 public multifamily REITs. We are the only one who has discovered the benefits of the Twin Cities. There's one other public REIT that owns one asset here. So our 5,000 units are definitely the most exposure to the Twin Cities in the public multifamily REIT space. In late 20 And for the majority of 21, you saw the best earnings performance and the best stock price performance from REITs focused on non-coastal areas. So the coastal cities got hit very hard with declining rents, increased vacancies, second half of 20 and throughout 21. And you saw that play through into their performance. Again, we had the benefit of not being in those coastal cities, having some of these strong secondary markets that performed very well. So we held up well in 21. Top quartile performer in the public REIT space. When you look at 22, I think the investment community is starting to price in and expect the return or the urban rebound of some of these coastal cities. So forecasted earnings growth in the public REIT sector has never been greater from a percentage growth perspective. So that investment community and those investors are expecting strong rebounds, primarily driven by their expectations that these coastal cities are going to snap back and they're going to see these COVID era leases roll. You're going to see large loss to lease on those leases, and you're going to be able to capture some pretty significant rent growth. We think we're going to be able to do that in our markets. Coastal areas are probably going to be able to do that as well, maybe to a greater degree. We will see. In terms of what we're trying to do and what we're trying to execute on within the public REIT space, which, you know, being a public REIT, that's kind of just a wrapper in my mind. Like, we all own apartment communities, we all manage them, we all try and provide a great resident experience. We have some SEC reporting things that we have to do, but within that public REIT sector, you know, we're trying to create something that's differentiated that public REIT investors can't get elsewhere. If you look at the large or the largest 7 public REITs, 80% of their NOI comes from what we call, or others call, the sexy 6 coastal cities. So we're not going to try and play in that space. You know, we're looking for markets that look like Minneapolis, Denver, Nashville, whether that be Salt Lake, Phoenix, Raleigh, Charlotte. Those are other places that we think about, and that's what we're trying to build.
Thanks. All right, I'll move on to Mox.
Yes, sir.
All right. Well, you know, last year we know was a record sale volume year for us brokers. 2.3 billion market rate traded.
Not 2.7.
I know. I was that included other stuff. So I focused on the market rate stuff, and I think we're all on the same page here. But again, that's a record for a market.
Absolutely.
So just general commentary on just, you know, where you know, obviously suburban dominated. You know, I think it was kind of 75-80% of that space was
Absolutely
suburban. We're just from a capital flow standpoint, you know, who's buying, who's selling. You know, we kind of, you know, I'll get other brokers, you know, feedback there. We can kind of get into the pricing trends and all that stuff.
Yeah. Well, good morning, everyone. Mox Gunderson with JLL Capital Markets, co-head the office here in Minneapolis, and have been fortunate to transact on a number of these sales that took place in the Twin Cities and suburbs here this year. I mean, Keith is right. The majority of the activity was in the suburbs. We saw very low transaction volume in the urban cores, St. Paul and Minneapolis. A lot of the sales that we saw, Keith, were in the value add tranche or bucket, as well as the new deliveries recently stabilizing in a lease up. And, you know, the buyers are, to, you know, what Grant and Matt have touched on with markets like a Nashville or a Raleigh or an Atlanta, who may be experiencing the rent growth. What they maybe didn't touch on is that the going rate is a 3 cap in those markets. So what we're seeing is, and not only a 3 cap with 20 to 25 bids and multiple rounds, not just one best and final, try 5. So what we are seeing is buyers coming to the Twin Cities, primarily in the suburbs, looking for yield and not as competitive of an environment. Those buyers primarily are discretionary funds. Think of the FPAs of the world, made a big splash. Jeff sold a nice portfolio with FPA, bought a lot of, as well as the peak capital partners of the world made a huge splash into our market last year, buying primarily newer construction. So a lot of discretionary funds. We have a lot of institutional GP, LP partnerships that are stepping into our market. And 2.3 billion is up from 1.5 in 2020. 2020 is kind of a throwaway year, but still a very significant, almost doubled the volume in the Twin Cities. And really the catalyst to that is chasing yield that you can't find in other cities.
As far as the outlook this year, what are we seeing? Obviously, there was a big portfolio that traded this past year, and this guy was involved to your right on a big portion of that. What are we thinking for this year?
Well, yeah, I keep hearing, both these guys to my right and left are some of the most active buyers in the Twin Cities. So
That's why they're up here.
Yeah, I know. I mean, I can't imagine what's going to happen if they actually start buying. I think 2.3 billion's in the rearview mirror. I think we're going to outperform in 22. I think that we have buyers that, again, to my earlier point, are sick of 3 caps and very, very competitive bid environments. I think that we do have rent growth on the precipice of 22. I think it was Tom touched on it earlier. There is no single family entry level homes for sale. Construction pricing is rising. We have a robust job market if they come back to downtown. And so we have a lack of housing, which supply and demand 101. We should be experiencing the rent growth, and we tend to lag other markets. I think it's coming, and I think we're going to have the buyers here chasing yield in 22. It is going to be more of the suburban story, Keith. I think St. Paul, we'll get to this in a little bit, is going to be stagnant for at least 12 months here. But I think Minneapolis proper is going to come roaring back. We've already seen several transactions here in 22 so far this year. Mr. Campbell to my right made 2 nice buys in South Minneapolis. We had Hines purchase a very large portfolio in Northeast in the Mill District. And then LiveCore Blackstone just re-entered our market. So I think that we're going to have kind of a resurgence of Minneapolis, which was dormant last year, and that should boost our overall volume above the 2.3 billion in my crystal ball.
It does seem like, Minneapolis, I think maybe just, given what, St. Paul did, we don't want to be like St. Paul. I think there's a feeling that if whatever they do, it will be, creative enough, to get people to, still transact. And like you said, Mox, we are seeing those transactions still. So in Minneapolis.
It's good. It's welcome.
Abe, just, again, I always like to get your perspective, kind of more of that private capital space, in apartments. I know you've been quite active, just general commentary on activity. I think you've shared with me that the buyer profile seems to have changed in that space and just pricing.
Yeah, good morning. Thanks, Keith. So, exactly right. We're seeing a lot of change right now in Minneapolis and St. Paul. I think generally speaking, if you look at the Twin Cities, although it's maybe not performing on the high end of the scale on a national perspective, but if you look back the last 10 years, I did a quick look back. The average price per door in 2011 was 63,000 a unit. Now, average price per door in 2021, 150,000. So might not be, if you're looking at annual rent growth, maybe not that impressive. If you're looking at, cap rate compression, not quite as impressive compared to other markets. But if you look at what the Twin Cities is, it's known as, a Midwest conservative type mentality, long-term holds. People come into this market not looking for that volatility or that quick gain. It's more the long-term hold type mentality. So I think we've done very well in that perspective. Yes, we've seen some challenges. Some of the challenges we've seen, rent control, as you discussed, crime, another big one. The crime, I think Minneapolis was one shy of a record for murders last year. St. Paul, I think, hit the record. So there's been some challenges, there's no question about it. At the same time, I think people see the Twin Cities for what it is. and they know that it's something they can rely on. We took a little dip maybe in pricing. I'd say Minneapolis probably, 10 to 15% on average. That's really submarket specific. You look at certain markets. I know CBRE had an asset they listed last year with Ted in Linden Hills area, had 15 plus offers and needed a lot of work on it in disrepair. And they had went up above this price and above anybody's expectations, is my understanding. We also had we had an asset in kind of the Thorny Hill East neighborhood. It was just classic brownstone. We had a lot of offers on it. Again, over 170 a door for a classic. So had some nice features, obviously, maybe not representative of the entire uptown market, but for the right asset, the right location, there's no discounting in pricing. So I guess getting back to your point, general Twin Cities, St. Paul been very slow. This past year, I think a lot of owners are on hold, kind of waiting to see what happens with rent control, see if they can stabilize their asset. In Minneapolis, the activity overall has been relatively okay or even good. As long as expectations come in line with what market pricing is, I think we've done quite well.
How does the outlook for this year? And that's private capital space. Again, I think we all think that St. Paul is going to be slow. I mean, just generally, suburbs. I mean, I know you do a lot of, work all over, but at the same time, it's more the urban locations. What's kind of your, focus on thoughts on the outlook for sale volume in that space?
I think, like you mentioned earlier, Keith, I think Minneapolis is going to learn from some of St. Paul's mistakes. St. Paul, in my opinion, made some big mistakes, and we're realizing that now, or maybe realized it earlier. But I think St. Paul has been very cautious. I know the city council members and the mayor is in direct communication with some bigger owners who have a big say in the Twin Cities. So very direct conversations, sharing real data on what we think the ramifications or the repercussions of rent control will be. And those conversations are being had, every day almost, or every week on a constant basis. So I think there's a lot more information in front of us. I think Minneapolis will be very cautious. And I think to follow that, I think a lot of the capital and investors here locally see that, and they're feeling more comfortable with that. And to follow, the listings we're bringing to market, we're getting a lot of activity, especially in Minneapolis. I think people have a bullish outlook, and they see, this is something that we're going to get through. You're looking at the stats, what we had before. I mean, the rent control, this is not really going to affect us that much. We're anyways in that 3% rent growth market. So if you really boil it down, there's really, it's not going to be that impactful, even if this does go through, which I don't think it will. But I don't think it's on that private capital space. I don't think it's going to have that much of an impact.
Steve, I know you recently had 3 kids born, so you're pretty proud of that. But and then it also kind of tells me you've got some historical perspective on this space. So yeah, and you also got a really good listing recently. So congrats on that. So maybe just give us kind of your thoughts on where you see us right now.
Yeah, thanks, Keith. Steve Michael Commercial Real Estate, and I'm a broker. I sell these apartment buildings in 5 states. So the lens that I see everything through is demand. And we get big demand for these buildings. If we get a quality listing in a great location, if I make 2 or 3 calls, I've probably made a call or 2 too many. There's big demand. And I think the other 3 brokers here might agree. We are lucky to be in this apartment business. I guess I got a note here, will this market continue? And my thought is, unless we see an interest rate spike, yes. And so that's kind of it from from that perspective, to me, it's simple. We are seeing demand, we're selling buildings. An interest rate spike might change the game a little bit, but that's the horizon as I see it. Why apartment buildings will likely continue this year. People are securing the real estate because it's costing more every year to build. And and then it's an inflation hedge, and there's a lot of money chasing these deals. This is a good business. The apartment business, the industrial business is the sweet spot in the nation right now. Lenders want to lend, buyers want to buy, and occupancies are up. Indicative of demand, since that's the lens I see my business in. I'll just springboard off of what Keith said. We put a building up for sale. It's kind of an icon apartment building in Minneapolis. Most of us who've been around a while remember when it was built. But the Cliffs of Minnetonka, 456 units, we put up for sale just Monday, 2-3 days ago. And this is in relation to demand. On the first day that it was offered to the nation, a good building might get 20, 30 confidentiality agreements signed the first day. We had 75 confidentiality agreements signed the first day, and we're over 100 now. It was just offered on Monday. It's 456 units, right on 394 in Minnetonka. The average income is off the charts for that area. The building is resort amenities. It was built to the 11s by Charlie Bellegarde, and it's still owned by their family today. And it is listed by Pete Michael and Heidi Addo. So if you want to know more, you can contact them over there. But in any case, that whole oration was just relative to demand. And we had the same scenario on about 3-4 weeks earlier on 361 units in Fridley. Similarly in Falcon Heights, these are just under contract. These are recent deals. These are not historical deals. 175 units in Falcon Heights, similar, the demand. So that's the lens I see it in. I say this because we're licensed in 5 states. So I'm bullish on everything. We have had 4, 5, 6 great years. We expect the same next year. I guess it really goes across the spectrum too. It's market rate, it's affordable, it's project-based Section 8s, it's Section 42s, it's everything. So from my perspective, they will be more expensive to buy now than they have in the past, but they'll be more valuable next year than they are right now. And if your business is apartments, buy. There you go, Keith.
All right. Thanks, Steve. I think you'll do just fine on that listing there. So congrats again on that. Jeff, just give us a little perspective. Obviously, the research guys talked about all the deliveries, and again, it was record year again for deliveries, especially in the suburbs and that. But it's just for the suburbs, just as far as sale activity, the cost to build today, is that resonating? I know it's resonating. Just how much is it resonating? With his investors, the basis, and just kind of maybe get into some of the returns, and I'll also get some of the other guys specific. What we're seeing for cap rates, some of the IRR, levered IRR hurdles that the people are trying to get to. You can chime on that.
Good morning. Thanks, Keith. I was sitting down there looking at the research guy's slide, and all I could think about was I'm glad we made the list. We're at the very bottom, last city name there. That's not really indicative of what we're seeing in terms of activity, though. There's plenty, like Steve said, there's plenty of buyers out there that are still looking to invest in Minnesota. I think one thing that's happening And that, not everyone is maybe aware of that Minnesota has some of the best private ownership than compared to most cities. And so some of the movement of that private ownership out of the city, I think is a huge deal for the Twin Cities. So it'd be good to retain those owners. I think to kind of summarize what everyone's kind of said here, the way I'm looking at the market right now is the last 2 years has been heavily focused on COVID, and there's tons of implications on that. And then looking forward, it's really going to be about inflation. Looking back, COVID, as the other speakers have said, has really pushed activity in the suburbs and has spurred a lot of the suburban development. Of the total market that sold, it used to be about 40% was Minneapolis, St. Paul, and now it's down to 20%. So that means 80% of the market is now transacting in the suburbs or beyond. The other thing is a third of the market sales are around new construction. So if you look at anything built in the last, call it 5 years, a third of the transactions are within that product range. So looking back, COVID has pushed a lot of people to the suburbs. It's caused jobs to move to the suburbs, all the things you could expect. It's caused a lot of that growth down in the southeast where things are more open. But looking forward, inflation is kind of there's tons of implications as everyone, if you read the newspaper, everyone's talking about. Cost increases is going to be a big thing. It's going to cause, I think, more rent growth than we're actually seeing now. I think that we maybe won't be on the end of that list in next year. I think we'll be higher up on that list and rent growth will kind of come back. But it also hurts on the expense side, which doesn't get talked about as much. With the rent control being capped at 3%, if prices increase on the expense side at 5%, that's clearly an issue. And looking what happened over COVID with all these small businesses, a lot of these landlords really kind of run a small business. If it's personally managed or if you're using third-party management, and you have, most of the landlords have 50 to 250 units, you don't have 100 employees, you have 20 employees or something. So that's been a huge pain. I think you're going to see a lot of consolidation at third-party management business. I think you're going to see people that have 50 to 250 units, start getting stressed out about how they're running the properties and considering selling and some assemblages of portfolios where, larger buyers can come in and buy some of those. And then on the expense side with regard to new construction, the costs, they used to be, well, compared to 2 years ago or a year ago, I'm kind of hearing that construction costs are up, 10% on average roughly. So maybe it costs 20 grand more to build a building per unit than it did a year or two ago. And with most of the trades that have occurred so far have been kind of in that 250 to 300,000 a unit for the typical 4 or 5 story suburban construction. We're starting to push on that limit for where the pricing is going to be. So you kind of have to bet on rent growth coming to help offset that. And then the last thing I guess I'd mention about the suburban construction is a lot of these cities really saw their first deal built, in the last couple of years, like Robbinsdale, their first deal built. Lakeville only had, as of recent, 2017, I think was their first build. Woodbury's just seeing their first builds. And most of the first ones that are built get leased up really fast. And then you see kind of a domino effect of 3 or 4 projects get announced right away after that. And those, sometimes are leasing up extremely fast and sometimes they're lagging a little bit. So all those projects need TIF. All those projects, I think most of them will be successful if you find a decent site. But it's not going to be as easy, I would say, to build something and sell it as it was the last 2-3 years, but they still will perform well.
Thanks, Jeff. And I agree that inflation hedge is definitely, gaining traction, and we're starting to see that resonate with investors and maybe, with the owners. Matt and Grant, maybe you can opine on that. And also maybe just, obviously you guys are both involved in, new construction. Anything more just on where those costs are today, where they're trending?
Yeah, the price of lumber is, lumber's acting like oil. And it's impossible to predict. It's getting political. In November, we increased the tariffs from Canadian lumber from 9% to 18%, which from an affordable housing perspective is just crazy. It's just becoming harder and harder to build. You know, our construction, we just broke ground on a deal in Omaha. We had it priced about 18 months ago, $50 million deal. In that 18 months, the price went up from 50 to 56. Now in the same time, rents went up 12%, so the deal penciled out, but it's really tough to price development deals right now with the price of lumber just going crazy. So it's just, it's a risk.
Yeah, I agree with Jeff's comment on per unit cost increases. We've talked to various developers over the past 3 to 6 months. Consensus feedback is up $20K a unit from 9 to 12 months ago, generally speaking, to build the same product. Also wanted to add, you know, we talked about demand and asset prices for 22. Steve touched on it by saying there is a lot of capital. I guess I would add to that. There has never been more capital chasing multifamily product in the history of time. So that is continued weight and support in my mind to asset prices staying at levels that they're at, if not increasing, even with initial interest rate increases. I think people are going to look through that in certain situations because there is so much money on the sidelines waiting to be deployed that needs a home. A lot of those fund managers or asset managers, you know, have to use that money or they quote unquote lose it. We look at Preqin fundraising data, which is a great resource, and their latest numbers are there's $380 billion that has been raised that has not yet been deployed into real estate. That's all sectors. However, in 2020, of all the private capital that was raised, 92% of that was raised and earmarked for industrial or multi. So you put all that together, you know, whether it's 25 bids or 6 bids, you have aggressive capital in my mind. And we're seeing that play out in our markets. You think Keith asked about pricing and thoughts as to where pricing is. So to touch on that quickly, and this is from the buyer perspective, not the broker perspective. So answers may differ, but in Minneapolis, we see new construction acquisition cap rates at high 3s to 4, Denver plus or minus 3.5, Nashville low to mid 3s. Why low to mid 3s in Nashville versus high 3s to 4 here? It is rent growth. People are underwriting and achieving higher rent growth. So if you're trying to get to an unlevered 4.5 or 5 at some year in your pro forma, you know, the bet is, can you get there quicker in Nashville versus Mini? And that plays through into that cap rate.
You know, as far as predicting, you can, I'll ask it, you know, and I agree with all this capital's out there. You know, I know, Matt, you really had a hard time raising money lately. I'm just being sarcastic. But how much of that interest, you know, we think interest rates are going to go up. The lenders are going to talk, you know, later at panels. So I don't want to get in too much on the lending side, but just how much, what would you guess how much we can absorb, you know, 25 basis points, 50 basis points before we see, you know, valuation erode?
Yeah, I think it's in the neighborhood of 50. I think people are going to absorb 25 basis points all day because they're going to look to the rent growth story. They're going to look to the lease trade outs that you're seeing on these COVID era leases that are rolling. They're going to think about inflation. To Jeff's point, you have to balance that on the expense side. But I think a 25 basis point increase to interest rates will scare off some. But again, so much capital out there chasing it that it's not going to scare away everybody. And as you guys know better than anyone, you know, you only need 1 or 2 folks who really want a community to trade it at a good price.
And, you know, there's also a lot of capital, and this is for the lending panel coming later, but there's a lot of capital on the banking and the finance side too. So I think that the banks, the lenders, life companies are going to have to absorb some of that in the form of spread. I think spreads go down if rates go up. I do think rates are going up. I don't think cap rates really change. I think they probably go down this year. There's so much capital in the market, like everyone's saying here. I mean, just anecdotally, we sold the deal, marketed a deal in Chattanooga, Tennessee last year, late 80s deal, nice deal, you know, kind of quasi value add. We had 35 offers, 28 of which were within $500,000 at the top level of one another. So we had a best and final with 28 groups. It went through about 5 rounds of bidding, like Grant was saying, so many of these properties go through. And the price went up, 15% through the process. And we had, selected a buyer. We could have picked 20 buyers to buy this. Selected a group, had significant 7-figure earnest money. The system is awash in capital. And everyone's fighting for any sort of semblance of yield, any sort of yield, anything. It's just, I've never seen it quite like this.
Matt, I think they would have fun hearing what you mentioned on the Zoom call in terms of your raising money just recently.
Yeah, so last year an opportunity came upon us late in the fall in Farmington, Missouri. 6 months ago, I didn't know where Farmington, Missouri was. It's about 45 minutes south of St. Louis. We found a nice property, good yield. We needed $18 million to buy it. We weren't sure exactly how our partner base would respond to Farmington, just being such a tertiary market. We sent an email out I think at 10 a.m. to our partners saying we needed to raise $18 million. And by 11:30, it was fully subscribed and we had a wait list of about 150 partners. It became an investor relations problem. But point being, the fight for yield, the hunger for multifamily is insane. I mean, you're not going to have any problem at all. You're going to have the same problem with Cliffs. You're going to have a hard decision to make. You're going to have a lot of disappointed people, a lot of hard phone calls. I hope the good phone call will be to me.
There you go. Thanks, Matt. Mox, maybe you can Grant kind of touch on some of the cap rates but yeah, maybe you can expand on that. Just, class B, and C, suburban,
Yeah, I got some
urban,
thoughts here.
and then just, how people are underwriting rent growth. Cause obviously that's one of the reasons we're not as, low as these other Sunbelt
Right.
states, just cause we're not underwriting.
Yeah, so
Double
first for cap rates, I think we need to substantiate what that's based off of. They're very subjective. So let's look at a year one cap rate, not massaged or brokered by me or my counterparts here, but a very realistic year one tax adjusted for sale cap rate. If you're looking at the best of the best assets, I happen to have just marketed one that is as true core high-end pricing as you're going to find in this nation. That's going to be in the high threes, Keith, on a year one tax adjusted cap rate to very low fours, but probably high threes. And really the metric that the type of buyer profile is looking at for those are on your levered and unlevered IRRs. Your levered IRR for a true trophy asset, for the audience, think like a 365 Nicolette. You're going to be in the very high single digits to very low double digits, but likely the high single digits and the very low 6 on an unlevered standpoint. If we move into some of the product that Jeff and myself and the other panelists have been selling the majority of, that newer construction, 4 or 5 levels of stick over podium, suburban, that's going to be in the the lower double digit on a levered IRR. You're going to push into the upper 6s to mid 6s on an unlevered, and your cap rate seems to fall. I think the average for last year was probably right around 4.5, but into the third and fourth quarter, that dipped into like a 4.25 cap on a year one tax adjusted. Really interesting opportunity in our market, if you look at it, is the spreads between B product, like Steve just listed in Minnetonka, and the A product have never been tighter. They're 4.25 caps to 4.5 caps. And so we've really never seen that spread that tight where you can sell a 1980s asset for a 4.25 cap in exchange, find historically awesome debt into a larger new asset at the exact same cap rate, upgrade your mechanical systems, your roof, your windows. And for the B product, back to cap rates, I think you're in that kind of 4.5 on the year one tax adjusted, and your levered returns are going to be in that 12 to 13, maybe 14 if the project's not in the greatest location. But yeah, the real opportunity there is the spreads, and they've never been tighter. So exchanging out of older product into new product, and you really don't lose any ground.
The only thing to add there too is that the new construction doesn't have trailing numbers. So you're all the numbers we're quoting here is based on what we think is going to happen. And sometimes they're even selling at, 90% leased, not even fully leased yet.
Yeah, to that point, I mean, they don't, pre-stabilized, it's definitely back. I mean, there's definitely bridge financing vehicles, Grant, you guys, I'm sure would, be open to the right structure there. And we also, you and I talked about just the delta between kind of that new and that value add is Mox is right on. It's the tightest it's ever been.
Yeah, I think Mox is spot on, which that has trended our eye towards newer construction, higher rent, lower CapEx communities, a lot less execution risk. I think in the B space, if you have any worry or heartache on ability to execute rent premiums, ability to execute renovations, to Mox's point, with spreads being as tight as they are, I don't know why you wouldn't focus on newer construction, less capital intensive product. On the pre-stabilized comment, Keith, wanted to add there that in Nashville in particular, we have seen that space just on fire the past 6 to 9 months. Deals are trading at 10, 15, 20, 30% occupancy. And we're seeing no pricing discount for those trades. The discount, quote unquote, is being able to actually secure a deal in Nashville and get control of product. In that case, probably against a bid pool or a competitive set that is 50% of what it otherwise would be if that were stabilized, because there are some buyers who are simply knocked out on pursuing pre-stabilized deals. So we've definitely seen an uptick there.
Mox, as far as like competition or maybe, the other brokers just to win deals. Again, we're not going 5 rounds, but we're definitely going multiple rounds. People are using non-refundable, earnest money at PSA to win deals. Just any, general commentary on that.
Yeah, I agree that Steve is going to have a lot of unpleasant phone calls to make. But, we're typically calling for offers generating, I would guess if we just call all product types and locations equal, on average about 10 offers. Keith, we're setting a best and final round or a second round bid, depending on how close those offers are, for about a week out. I think what's interesting about our market, and I don't know if the other brokers have seen this as well, but tour activity is down, and we see groups waiting to, if they get into that second round of that best and final, and then they fly in and you have a flurry of tour activity. If the contest is really tight, we may open it up to a third round bid, but usually it goes from call for offers to a best and final. And, hopefully you have 2 or 3 groups separate themselves and you do a buyer interview call, take some of the heat off the broker in the decision-making process, and let Matt or Grant decide which one they want to go with. So if it falls apart, the egg's on them. But it is competitive. Terms are pretty typical. Terms are going to be, I suppose most standard terms are going to be a 30-day due diligence with a 30-day close after that. Most buyers are inserting a 30-day extension for additional earnest money, non-refundable earnest money. If the bidding process is real competitive, we're able to dip that due diligence down to 21 days, maybe below. For the best of the best, we're seeing groups come in all cash, close in 40 days. But that's pretty rare. Most deals, due diligence is starting from the signature of an access agreement. So we don't have to wait for the attorneys to have a meeting of the minds weeks later. So we start the due diligence right at an access agreement, and then can work on the purchase agreement simultaneously. But yeah, that's my thoughts on kind of terms in the bid atmosphere in Minnesota.
Yeah, and Mox, I think you're right with as far as the tour activity, there's definitely, and it's COVID related as well. Just people are again trying to be efficient with their time. A lot of people are waiting to see if they're in the mix before they jump on a plane and get up here. Now, Jeff, maybe just some commentary just on the outside capital, local capital, and maybe Abe as well, or just what are we seeing on that front? I mean, in my eyes, it's still dominated by the outside capital.
Yeah, one thing. So I agree with everything Mox said. One caveat I would say, because the money's so pressured, sometimes there are scenarios where you would want to do, you still need to have a broker or someone go out and get feedback from the market. And if you find someone with pressured money, that whole process may change. To Grant's point, he just said he's not going to compete on something that's going to have 5 rounds. So if Grant's your buyer, then maybe that's the route to go in certain scenarios, of course. In terms of where the capital is coming from, it is mostly outside of Minnesota, I would say. Most of the groups have already made some sort of entrance here. We're starting to see, as we have in the last 5 years, see new groups enter every year. But back to my previous point of having a capacity to take on the management side of things, you need to really have a large presence here. So depending on the asset size, that really determines where the capital comes from. The most activity in Minneapolis for kind of mid-tier or lower tier size deals is really a lot of syndications where it's, people raising money to go buy and operate either with themselves or third party. There's been a handful or a number of transactions that way. But the guys, the typical buyers that are some of the largest landlords in Minneapolis and St. Paul, those are the guys that are really on the sidelines right now, which we obviously hope will change because there's in my opinion, some of the best landlords that take care of the properties and are good for their tenants. But yeah, generally it's out of state money, typical areas, coastal markets.
Abe?
Yeah, and I would say, so it's going back to terms for a second. I mean, again, on the right deal, there's a lot of activity and a lot of interest. And we've seen on several deals where, just so competitive, you got 5 or 6 or 7 guys who want it, goes above list price. And then, you see buyers put down non-refundable earnest money. So 1 or 2% non-refundable, 5+% above list price. Hey, I want the deal, not even contingent on seeing the units. So, and in the right deal, even in Minneapolis, there's a lot of demand. As far as capital, I think Jeff is spot on. More syndicates, a lot of newer capital, younger buyers who are getting into the game, see more and more of that. Or, this might be the first or second deal, but then they start building up a track record. So we're seeing, more and more on that. While I'm at it, hope to bring out 84 units in Robbinsdale. If anybody has any interest, feel free to PM me or flag me down later. Great deal, Class C. I think some good upside, and I feel it's priced right. So.
One anecdote on the term side, I just wanted to jump in with. The room may find it interesting. I certainly didn't. There was a deal in Nashville that we were pursuing and got to a spot where we had put forth a second or third revision of what we felt like was a very strong offer, all cash, quick timeline, be efficient. There was a Forbes 400 individual from California who came in at the tail end of the discussion that we were having with ownership. He had a 1031 exchange, high net worth individual, doesn't have an investment committee. He answers to himself for the most part. And he came in price equivalent to our number. And his offer was that price. If you award me the deal, I will fund $5 million non-refundable earnest money tomorrow. The only carve out I will have on that is for title review, making sure everything checks out from a title perspective. And if awarded the deal, we will not send anybody on site to conduct on-site due diligence activities. We will do it all remotely. Now, I don't think that will become the new normal. So I'm not proposing that it will be or saying that it should be. I think that's crazy. But it's one example of capital demand, capital flow, capital desire. We can't compete with that. We weren't going to compete with that. So unfortunately, we didn't secure that deal. We are going to do on-site due diligence. But one example.
And you just kind of touch on it. And again, it's the 1031 money, it's still out there. And quite frankly, a lot of people are trying to get deals closed, this year, just to make sure in case the threat goes away, people are, trying to get deals closed, last year, just afraid that, taxes going up. So there seemed to be a pent up demand. Seems like we've got more time for that, but it'd be interesting to see how that plays out. I know I got to wrap up here, but I do, maybe just a final question for Matt, just if there is any, governors, and seems like there's plenty of capital out there. What do you think that is? I mean, my sense is, rent control is one, regulations is another, but just costs, just what's kind of your thoughts on that? If there is any governor, interest rates.
As far as headwinds in the Twin Cities here.
Yep.
Where's our growth coming from here? Where's our job creation coming from? In the Sun Belt, office vacancy is lower today than it was pre-pandemic. When do people go back to work? When does our downtown get going? That's my biggest concern with the Twin Cities is where are people coming from? Because they're not moving here for our weather. Target's kind of a work wherever you want right now. When are these businesses going to bring people back? And where are jobs going to be created here? That's my biggest concern with the Twin Cities.
Okay. Well, I think we have to wrap it up. Again, a terrific panel. And again, the apartment market's certainly been on fire, and it was a record year. I mean, I'll speak for our team. We was first, we hit over $1 billion just for our team last year. So it's certainly been a good space for all of us. So thanks, everyone.